Welcome to this week's edition of Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the S&P 500. I'm going to cover the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only. It doesn't take your personal situation into account. With all of that said, let's get into our first chart. So I've got the S&P 500 up on the screen, and it's been a quiet week. It's been a quiet week for the S&P 500. It's been trading in a narrow range since last Thursday. You can just see the narrow bars on each daily range since then. And of course, I'm recording this on Friday afternoon in Sydney, so this may all change on Friday in the US. But so far, this is the first week this month since there hasn't been a new all-time high in the S&P 500. And that's interesting in itself. And some people may wonder, look, is that a concern that we haven't had an all-time high this week? And the answer is simply no. It's not a concern at all. In fact, I think that it's good that the market is pausing to consolidate, because the way things often work is that rallies tend to be more sustainable when there are pauses, when there are consolidations within an upward move. It's when prices rise day after day, week after week, things become euphoric. That's when you really need to worry, but that's not what we're currently seeing at the moment. And so I think that just looking at this price action that we have here in the S&P 500, look, just in the last week, this tight compression band, these typically resolve to the upside. When you get a market that rallies, goes sideways for a period, tends to resolve to the upside. So it seems to me that it's more likely than not that we'll have a new all-time high in the S&P 500 before too long. As it stands, this remains a bullish chart structure, clear upward trend. I think the base case continues to be, and this has been the case for some time now, it's stay long, let profits run. If you've got positions in S&P 500 index itself or the stocks within it and they're doing well, it's let those profits run, let the trend continue to do its thing. Same applies to the NASDAQ. At this stage, it still does remain a fairly narrow rally. You can see this playing out in the FANG index. So if we just jump across to the FANG Plus index. So this is an index made up of 10 big tech stocks. So the likes of Apple, Microsoft, NVIDIA, and several others. It's you look at this, it's so different to other sections of the market that we can look at. And you just see the strength of this upward trend that's in place. Unlike the S&P 500, it has hit a new all-time high this week. So the trend is very much up there as well. No signs of the top. Path of least resistance remains to the top side. Now, contrast what you see here with what we see when we go and we have a look at the S&P 500 on an equal weighted basis. So the biggest stock and the small stock are weighted the same. And it's a very different story. What we see here is the broader market is still not confirming the highs in big tech. So it really does remain a two-speed market. Big tech is running. Most of the other stocks, they're consolidating sideways. And that's been the case for several months now. Now, this isn't necessarily bearish. It's not necessarily bearish at all, because when you look at the price structure on this chart, we've got a rising upward move from the October low, and we've got a sideways period with prices consolidating along the moving averages, and I've got the 50 and the 100-day moving averages. What often happens when we get these sideways periods is the sideways period is a holding pattern prior to further strength. So this could all well and truly resolve to the upside. And if we do get a breakout to the upside, I think that'd be a bullish sign that then could see that trend in the S&P 500 extend further. But of course, we don't have an upside break at the moment. We have a market which is trading sideways. And what's also interesting here, just in the last month, you can see the price is really starting to compress, really compressing right near this 50-day moving averages. And we've got some really clear levels to watch. So this week's high, for instance, just here at around 166.5, I think that's a key point to watch. And then on the low side, we have the low from June, June's low, which comes in around 162.5, also coincides with around the 100-day moving average. So I think these are really important levels to watch. And the ETF which I'm using to show the equal weight is RSP. It's an Invesco S&P 500 equal weight ETF. As I said, if we do see this break to the top side, I think that would be positive. I think it'd be bullish. I think it'd be positive for the market overall. But we need to wait. We need to wait and see which way this goes. I'd have a bias to the upside, but we don't know until we do get a break. Now, I've got something else which I think you're going to find interesting to have a look at in a sec. First of all, though, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks to the video. Then YouTube goes and sees you're engaging, shows other people, helps me a lot, helps the channel a lot when you do those things. And hit that subscribe button if you haven't already done so. Now, something else I want to show you. This is interesting. This is the S&P 500 stocks. Well, this is the percentage of S&P 500 stocks above their 100-day moving average. And this is something I've been keeping a close eye on. What we saw a couple of weeks back, it started to break lower. So it got down to only 43% of S&P 500 stocks being above their 100-day moving average. What we've had, though, is we've had a snapback rebound in this indicator, got back up to around 57%, it's pulled back a bit, it's currently around 50%. What I think is interesting here is that stocks seem to, maybe they're becoming resistant to breaking down. They're becoming resistant to we're not seeing an increasing number of stocks falling below their 100-day moving average. It seems to be being supported around this 50% mark over the last couple of months. And so maybe this is a sign that we're not going to see a continued deterioration in, say, like when you look at the equal weight. And in fact, we may start to see a broader rally in the markets if this percentage of stocks below their 100-day moving average does stabilize here and start to push higher. Something to keep an eye on over the next few weeks. I'm also keeping an eye on the Russell 2000. This is the small cap, so US small cap index. I suspect most people aren't following this at all, and I can completely understand why. It just hasn't been doing much over the last few months whatsoever. And this certainly is not, it's not where the money is at the moment. It's really been in a broad trading range for the entire year. So we can just box that up there, and that's this year so far for the Russell, just tracking sideways. And this could remain in a holding pattern for months. We don't know. At some point, I do think this could potentially lead to a great upward trend. We're not there at the moment. We don't have a breakout. I don't know when that may be, if that occurs at all. But there are some clear levels to be aware of. And I think this is important. So if we were to get a break above the May high, the May high and the April high, which are quite close to one another, that would be, I think that would be a positive sign for the market overall, and a sign of a broader rally getting underway. So I think that's what we want to watch on the Russell. Just keep an eye on the Russell. I don't think it's a place to be actively investing in at the moment, but just watch these previous highs, watch for the breakout from this range if it comes to the top side. And I continue to be long stocks. My preference is to buy stocks that are breaking higher, buy stocks that are rallying off their moving averages. So I use the 50 and the 100-day moving averages. I'd rather do that just simply pile into the index. And of course, it's all about managing risk as well. So no matter how strong a market is, it's never a one-way bet. So S&P 500 trend is up, no sign of a top, but as I say, it's never a one-way bet. Always manage risk, always have an exit strategy in whatever it is that you trade. So look, I think we will leave that there for this week. Thank you for joining me. Thanks for being part of this week's Trade the Trend. I'll have that ASX edition coming up shortly with gold, silver, oil, and uranium. I look forward to coming back and talking to you again next week. Till then, bye for now.